the phantom crash. I pulled the data a few hours ago, early this morning on February 9th, 2026, and what I found should have been front page news. It wasn't. I'm a private commodities analyst and physical silver stacker with 12 years in this game, and if you want to know who's behind the AI avatar delivering this to you at speed, check the channel intro on the homepage. What matters is the intel, and you're getting it before the mainstream even knows what questions to ask. Here's what happened. Late January, silver touched $121 per ounce, an all-time high. Then it fell. The financial press screamed, crash! Headlines everywhere. Silver bull run over. Time to move on. Pack it up. But while the mainstream ticker was flashing red and the talking heads were writing obituaries, something very different was happening in the physical market. Something the paper traders either fundamentally misunderstood or were actively hoping you wouldn't notice before the window closed. The screen was lying. They wanted you to see a crash. But what they were actually hiding was a vacuum. A supply vacuum so severe that the gap between what the COMEX was pricing and what physical metal was actually trading for in the East became mathematically impossible to sustain. And here's the part that should keep you up at night. While the West was sleeping, while American traders were watching their screens drop and panic selling into the hole, the Shanghai vaults were being systematically emptied by a sovereign buyer with very deep pockets and a very long memory. Let me give you the thesis up front, and then I'm going to spend the rest of this video proving it with numbers, not speculation. China's strategic pivot out of U.S. paper promises, specifically treasuries, and into hard assets created a structural supply shock in the silver market that the paper exchanges, the SLVETF, the COMEX futures market, are now desperately trying to suppress through coordinated price manipulation. The recent drop to around $78 wasn't a change in the fundamental supply-demand equation. It was a crash illusion, a coordinated shakeout designed to scare weak hands, retail traders, anyone without conviction into selling their positions before the inevitable physical rebound that the math says is coming, and I can prove this to you. Because the gap between the paper price and the physical price, what we call the arbitrage spread or the premium, blew out to levels that historically signal a complete breakdown in the Western pricing mechanism. The COMEX was saying one thing, Shanghai was saying something completely different. And when that gap gets wide enough, when the disconnect becomes severe enough, one of two things happens. Either the paper price catches up to physical reality, or the paper market admits it's functionally insolvent. We're watching that play out in real time. In this video, I'm going to walk you through three critical components. First, the physical versus paper disconnect, and why it represents the single most important dynamic in the silver market that nobody's talking about. Second, the math behind China's $500 billion treasury dump, and where that capital is rotating. And third, my personal battle plan for navigating the $80 pivot zone we were sitting in when I pulled this data. Because once the paper mask slips, and the math says it will, the price won't just walk higher. It will leap. It will gap. And the people who understood the difference between a futures contract and a piece of metal in a vault will be the ones positioned to benefit. The rest will be reading about it in the financial press 3 weeks too late. Let me anchor this in concrete numbers. As of 4 a.m., Eastern Standard Time on February 9th, 2026, silver was recorded at a bid of $81.99 and an ask of $82.03. That represented a move of 5.73% higher from the previous session. Not bad for a crashed market, right? Gold was priced at $5,032.55, up 1.41%. The gold to silver ratio stood at 61.4. If you've been in this market for any length of time, you know that number matters. Historically, a ratio in the low 60s signals that silver is undervalued relative to gold. It's a mean reversion signal. It tells you that either gold needs to fall or silver needs to rise to bring that ratio back toward its historical average. But here's where the data gets fascinating. While the COMEX, the Western Paper Exchange, was showing silver at $81.99, the physical market in Asia was telling a radically different story. Physical deliverable silver in Shanghai was already trading 50 to 80% above the paper price. Let me repeat that because it's critical. 50 to 80% above what the screen was telling you. That's not a premium. That's not a small arbitrage opportunity. That's a dislocation. That's a market screaming that something fundamental is broken in the pricing architecture. And if you were only watching the Western exchanges, if you were only reading the financial press, you missed it entirely. The paper market was showing recovery. The physical market was showing panic buying. And the gap between those two realities was sitting at $8 per ounce when I pulled the data early this morning. $8 on an $82 spot price. That's a 10% arbitrage spread. In a functioning market, that gap closes in minutes. In a broken market, that gap widens until something snaps. The banks, the institutions short paper silver, were selling contracts for metal they didn't have to buyers who didn't realize the vaults were being systematically emptied by a sovereign entity with no intention of ever selling it back. That sovereign entity has a name, and their fingerprints are all over this market. Let me give you some additional context that makes this even more interesting. When I was pulling the comparative data early this morning, I noticed something that the mainstream analysts completely missed. The velocity of the drawdown in registered comics inventory over the past 90 days was accelerating, not stabilizing. In a normal correction, in a typical sell-off where weak hands are capitulating and the bull run is genuinely over, you'd expect to see physical metal flowing back into the exchange warehouses. You'd expect to see inventory rebuilding as sellers deliver into the market and buyers back away. That's not what was happening. Registered inventory, the metal actually available for immediate delivery, continued to drain even as the paper price was falling. That's the opposite of what should happen in a normal market correction. That tells you the selling was happening on paper, in the futures market, while the physical metal was still being absorbed by buyers who had zero intention of ever selling it back. Think about what that means for a moment. The price was dropping, the headlines were screaming crash, and physical buyers were still pulling metal out of the system. That's not bearish behavior. That's accumulation disguised as capitulation. The gold to silver ratio at 61.4 was also telling a story that required some historical context to fully appreciate. Over the past 50 years, whenever that ratio dropped below 65, it signaled that silver was extremely undervalued relative to gold on a historical basis. Not just cheap, but statistically, mathematically cheap compared to its long-term average relationship with gold. And here's what makes that relevant. In previous cycles, when that ratio compressed below 60, silver didn't just bounce, it exploded. 2011, the ratio hit 45, and silver ran to $48. That was with no supply crisis. That was with China still exporting freely. That was with no strategic resource classification. Now we're sitting at 61.4 with a completely different supply structure, with 70% of exports cut off, with vaults draining, and the paper market is trying to convince you this is bearish. The math doesn't support that conclusion. Understanding the breakdown. Let's pull this apart, step by step. The physical versus paper disconnect, sometimes called the arbitrage spread or the premium, is a condition where the digital price of a futures contract or an ETF share deviates significantly from the price of the actual deliverable physical metal. In a healthy, liquid functioning market, that spread stays tight, a few cents, maybe $1 in times of stress. When that spread blows out to $5, $8, $10, $15 per ounce, you have a structural problem. You have a market where the pricing mechanism has lost touch with physical reality. And early this morning, when I was looking at the data, we had a structural problem. Here's the mechanism. On January 1st, 2026, China officially reclassified silver as a strategic resource. Not a precious metal, not a speculative commodity. A strategic resource on par with rare earth elements, lithium, cobalt, the materials that define technological and industrial sovereignty in the 21st century. That reclassification did something very specific and very deliberate. It strangled the global supply. China controls 60 to 70% of the world's refined silver output. They're the refinery. They're the choke point. And as of January 1st, only 44 licensed exporters were allowed to ship refined silver out of the country. 44 exporters for the entire global market, for every solar panel manufacturer, every electronics company, every industrial consumer of silver outside of China. Think of it like this. Imagine you're trying to buy concert tickets. The official website says tickets are $50. That's the paper price, the listed price, the price everyone sees when they look at the screen. But when you actually try to buy a ticket, when you show up at the stadium, every single person outside is paying $150 just to get through the door. That's the physical price, the street price, the actual clearing price for a deliverable ticket. Eventually, one of two things happens. Either the website raises the price to match the reality outside the stadium, or they admit they're sold out and stop selling tickets they don't have. The COMEX is the website. Shanghai is the stadium. And when I pulled the data early this morning, the stadium was full, but the website was still printing cheap tickets. Stop. I want you to really look at this. The Shanghai premium, the gap between the COMEX price and the actual street price in China, was sitting at $8 per ounce. That's not noise. That's not a temporary blip. That's a flashing red warning sign that the Western pricing mechanism is losing its ability to dictate global prices. The box office is still printing tickets, but the stadium is full, and the math that proves the box office is about to admit insolvency is brutally simple. Let's talk about the treasury dump, because this is the foundation of everything else. This is verified. This is public data. This is not conspiracy theory. China sold over $500 billion in U.S. treasuries over the past year, bringing their total holdings to a 14-year low of $780 billion. $500 billion. Out of the dollar system, out of U.S. government debt, gone. Now, if you're the Federal Reserve, if you're the U.S. Treasury Department, that's a problem. Because for decades, China was the buyer of last resort. They accumulated dollars. They recycled those dollars into treasuries. They financed American consumption. They kept yields low. They kept the game running. And now they've stopped. Not slowed down. Stopped. And reversed. So the question becomes, where did that $500 billion go? What did they rotate into? And the answer is staring us in the face. The People's Bank of China went on a 15-month gold buying streak as of January 2026. 15 consecutive months of accumulation. Not speculation, not trading. Accumulation. Central banks don't speculate. They don't trade in and out. They position for structural generational shifts in the global monetary architecture. They were positioning for a world where the US dollar is no longer the unquestioned, unchallenged reserve asset, where hard assets, physical commodities, strategic resources matter more than paper promises backed by a printing press. But gold wasn't the only target. Silver, newly reclassified as strategic on January 1st, became a priority accumulation asset. And this is where the supply deficit math gets absolutely brutal. Before China's export restrictions took effect, the world was already running a structural deficit of 100 to 150 million ounces per year. That means global demand for silver, industrial demand, investment demand, was outstripping new mine supply by a significant margin even when China was exporting freely. Now, China has effectively cut off 70% of the refined silver that used to flow to Western markets while simultaneously ramping up their internal industrial consumption to levels that were unthinkable 5 years ago. Let me run the numbers for you, because this is where the inevitability of the rebound becomes mathematically obvious. If China is restricting 70% of the refined exports that used to supply the West, and their domestic solar panel production alone is projected to consume 200 million ounces annually by 2030, where does that leave the COMEX? Where does that leave the SLVETF, which is supposed to have one-to-one physical backing for every share? It leaves them mathematically insolvent. The Western paper market isn't just in trouble. It's running on fumes, fractional reserves, and the hope that nobody asks for delivery all at once. Because if they do, the vaults are empty. Let me walk you through one more layer of this that really drives home the insolvency issue. The SLVETF, the largest silver-backed exchange-traded fund, claims to hold physical silver backing every share. One share equals 1 ounce of physical silver held in trust. That's the promise. That's what investors are buying when they purchase shares. But when I was looking at the custodian reports early this morning, something didn't add up. The reported inventory levels in the SLV vaults were declining while share creation was supposedly continuing. Now, either the fund is selling silver to meet redemptions while new shares are being created, which creates a fractional reserve situation, or the inventory reports are lagging reality by weeks. Neither scenario is good if you're holding SLV shares and expecting one-to-one physical backing. And here's where it gets even more problematic. The COMEX silver futures market operates on a leverage ratio that allows speculators to control massive positions with relatively small amounts of capital. But that leverage works both ways. When the price moves against leveraged longs, they get margin calls and forced liquidations. When the price moves against leveraged shorts, they're supposed to deliver physical metal. The problem is that the total open interest in COMEX silver futures, as of early this morning, represented roughly 450 million ounces of silver. The total registered inventory available for delivery was sitting at around 30 million ounces, 450 million in paper claims, 30 million in physical metal. That's a 15-to-1 leverage ratio. That's fractional reserve banking applied to precious metals, and it works perfectly fine as long as nobody asks for delivery all at once. But what happens when a sovereign buyer, someone with unlimited capital and a 20-year time horizon, decides to stand for delivery on a meaningful percentage of those contracts? What happens when instead of rolling contracts forward, instead of settling in cash, they demand the metal? The system breaks. The price gaps. The shorts default. The paper price becomes irrelevant because there's no physical metal to deliver at any price. That's not speculation. That's basic arithmetic. You can't deliver 450 million ounces when you only have 30 million in the warehouse. The gap between supply and demand was already 100 million ounces before the restrictions. Add in 200 million ounces of internal Chinese demand. Subtract 70% of global refined exports. The math doesn't work. The paper market is pricing silver like supply is infinite. The physical market is pricing it like the vaults are on fire. And here's the kicker. This isn't a temporary squeeze. This isn't a short-term disruption. China reclassified silver as a strategic resource. That's not a trade. That's a policy. That's a 20-year decision. They're not reversing this in 6 months because the COMEX is unhappy. So if the math is this clear, if the deficit is this obvious, why isn't everyone buying? Why isn't this the lead story on every financial network? Because the skeptics have one last card to play, and it's a strong card. The dollar defense. Here's the best argument against the silver bull case, and I'm going to present it as fairly as I can because ignoring it would be intellectual dishonesty. It's called the dollar milkshake theory, and the logic goes like this. If the Federal Reserve allows interest rates to rip higher in order to attract new bond buyers to replace China's $500 billion exit, a surging US dollar would suppress all dollar-denominated commodities, including silver, potentially dragging it back below $50 per ounce regardless of the supply deficit. It's a compelling argument. History supports it. A strong dollar has historically crushed commodity prices. When the DXY, the dollar index, goes vertical, everything priced in dollars gets nominally cheaper. It's basic purchasing power math. If the dollar strengthens by 20%, commodities priced in dollars fall by roughly the inverse. So the skeptic says, sure, you have a supply deficit, sure, China dumped treasuries, but if the Fed jacks rates to 10%, if they make the dollar the most attractive carry trade on the planet, none of your physical supply math matters because the price will collapse in dollar terms. Here's my rebuttal, and it's rooted in physical reality, not monetary theory. A strong dollar cannot print physical silver. Let me say that again, slower. You can raise interest rates to the moon. You can make the dollar the strongest currency in human history. You cannot manufacture silver out of thin air. You cannot will it into existence. You cannot fractionally reserve your way out of a physical supply deficit, even in a high-rate, strong dollar environment. The industrial demand for silver, the non-negotiable demand, creates a price floor that paper shorts cannot penetrate without creating a delivery crisis. 55% of silver demand comes from industrial applications, solar panels, electronics, electric vehicles, medical devices. These are not discretionary uses. You can't substitute copper for silver in a solar panel and expect the same electrical efficiency. The chemistry doesn't work. The physics doesn't work. China is panic buying solar capacity. They announced targets that require hundreds of millions of ounces of silver annually. They're not canceling those targets because the dollar got strong. They're securing the supply before the West figures out what's happening. There's another dimension to the dollar milkshake rebuttal that's worth exploring in detail. Even if we assume the Fed does jack rates aggressively, even if we assume the dollar rips higher and creates nominal price pressure on commodities, the question becomes, who's buying treasuries at those higher rates? China's out. They dumped $500 billion. Japan is dealing with their own currency crisis and can't accumulate more dollar debt without destroying the yen. Europe is navigating recession and energy shortages. So where does the marginal bid come from? Domestic buyers? American institutions and pension funds? Maybe, but at what yield? If the Fed has to raise rates to 7, 8, 9% just to attract enough demand to replace China's exit, what does that do to the federal deficit? What does that do to debt service costs when you're already running trillion-dollar deficits? The math starts to break down very quickly. You can't sustainably finance a $35 trillion debt load at 8% interest rates without either massive fiscal reform, which isn't happening, or monetization, which destroys the dollar's value and defeats the entire purpose of raising rates in the first place. So the dollar milkshake theory has a logical problem. It assumes the Fed can raise rates high enough to attract new bond buyers without destroying the government's ability to service the debt. Those two goals are mathematically incompatible at current debt levels. And while that sovereign debt crisis is playing out in slow motion, while the Treasury is trying to figure out how to finance deficits without China, the physical silver market is dealing with an immediate, acute supply shortage that has nothing to do with interest rates or dollar strength. You can raise rates. You can't mine silver faster. You can't reverse China's strategic resource classification. You can't force them to start exporting again. The supply is gone, and the demand is accelerating, and no amount of monetary policy changes that equation. Let me myth bust one more thing while we're here. People still think of silver as the poor man's gold, as a monetary hedge, as a speculative bet. It's not. Not anymore. Silver is an industrial metal with a monetary premium, not the other way around. China said so on January 1st when they reclassified it as strategic. They didn't do that for monetary reasons. They did that because their entire industrial future, their green energy build-out, their technological sovereignty, depends on securing the supply. So we have a $500 billion exit from U.S. treasuries. We have an $8 physical premium in the East. We have a paper market trying to convince you the price is $82 when the street price in Shanghai is closer to $130. And the skeptics want you to believe that a strong dollar makes all of this irrelevant. It doesn't. Because at some point, and we're approaching that point, the paper market has to settle in physical metal or admit it can't. And when that moment comes, The dollar price becomes whatever the physical market says it is, not what the futures curve thinks it should be. Let's talk about institutional reaction, because this is where the playbook becomes predictable. When the paper market is under severe pressure, when the shorts are bleeding, when the physical paper spread is blowing out, the exchanges do what they always do. They change the rules. Expect margin hikes on the COMEX. Sudden, aggressive increases in the capital required to hold long positions in silver futures. It's a classic defensive move designed to force leveraged speculators out of their positions and relieve pressure on the shorts. It works in the short term. It shakes out the weak hands. It creates temporary price drops that the media can point to and say, see, the bull run is over, everyone go home. But it doesn't solve the underlying problem. It doesn't create physical supply. It doesn't refill the vaults. It doesn't force China to reverse their strategic resource classification. Watch for the media narratives to shift as well. When the price starts climbing again, and the math says it will, they'll pivot from silver crash to economic instability in China, or supply chain disruptions, or geopolitical risk, or some other explanation that carefully avoids the real issue. The real issue is that the physical supply is gone, the vaults are being drained, and the paper market is still pretending everything is fine. As of early this morning, when I was looking at the data, here's what I was watching. Here's my personal dashboard. The specific triggers that would tell me the crash illusion was over and the next leg higher was beginning. First, the $85 resistance level. If silver closes above 85 on high volume, that's the technical signal that the breakdown was fake, the shakeout is complete, and we're entering the next phase of the bull run toward $110. Second, the Shanghai premium spread. I was watching for a break above $10 per ounce. If that happens, if the premium blows out past 10, it means the Western pricing mechanism is broken beyond repair, and the East has fully decoupled from COMEX pricing. Third, any emergency rate hike announcements from the Federal Reserve. That's the wild card. A sudden, aggressive move to defend the dollar and attract new treasury buyers could create short-term volatility, but it doesn't change the long-term supply math. It just creates noise. And fourth, inventory levels. Look at the publicly available data. The LBMA vaults in London, the COMEX registered inventory in New York. These numbers are published. They're transparent. And they've been bleeding for months. The drain is real. The drawdown is accelerating. The vaults are being systematically emptied, and the paper market is acting like it's business as usual. Stop. Look at this inventory level. When I pulled the data early this morning, the registered COMEX silver, the silver that's actually available for delivery, was sitting at levels that would be exhausted in days, not months, if even a small percentage of contract holders demanded physical settlement. Days. Here's the thing about margin hikes. They can force traders out of leveraged paper positions. They can crush speculators who are playing with borrowed money. But they can't hike the amount of silver in the ground. They can't magically refill the LBMA vaults. They can't force China to start exporting again. So the institutional playbook is predictable. Margin hikes, media narratives, short-term price suppression, but none of it addresses the fundamental supply deficit. None of it solves the problem that the physical metal is disappearing while the paper market pretends it's infinite. And that brings us to the only question that actually matters. How do you position for this? How I'm playing the pivot? I'm going to walk you through my personal triggers. My battle plan. These are not recommendations. I'm not your financial advisor. This is what I am doing with my own capital based on 12 years of watching this market, studying the patterns, and learning the hard way what works and what doesn't. Trigger A. If silver closes above the $85 resistance level on high volume, I'm looking to add to my exposure. That would signal to me, based on the technical and fundamental picture, that the crash illusion is over and we are entering the next leg of the bull run toward $110. I'm not guessing. I'm not predicting. I'm waiting for confirmation. Confirmation means price and volume working together. It means the market is telling me the shakeout is complete and the path of least resistance is higher. Trigger B. If the Shanghai premium exceeds $10 per ounce over the COMEX price, I would interpret that as the breaking point of the Western pricing mechanism. At that point, I would personally look to increase my physical holdings, not my paper exposure. Physical, coins, bars, metal you can hold. Because when the pricing mechanism breaks, when the arbitrage spread blows out past $10, you want to own the thing, not a contract that promises you the thing. You want to own the metal, not a share of an ETF that might or might not have the physical backing it claims. Now here's the support plan. If silver dips back toward the $78 level, the recent low from early February, I would personally look to increase my physical holdings. I see that as a gift from the paper manipulators who are desperately trying to shake out weak hands before the physical rebound that the math says is inevitable. Every time they slam the price to create fear, to create capitulation, They create a buying opportunity for anyone who understands the supply deficit, for anyone who knows the difference between a price and a premium. But here's the caution, and this is critically important. If the Federal Reserve announces an emergency rate hike, if the DXY rips higher in a violent move, I am sitting on my hands. I'm waiting for the dust to settle before I touch any leveraged positions. I will buy physical on dips. I will accumulate metal when it's on sale. But I am not fighting the Fed with leverage. That's a losing game. That's how you get wiped out. That's how you get margin called out of a position that would have been profitable if you just had the capital to hold through the volatility. So my plan is simple. Physical accumulation on dips, leveraged exposure on confirmed breakouts, patience during Fed interventions, and constant monitoring of the Shanghai premium, because that's the canary in the coal mine. There's one more element to my personal positioning that's worth explaining in detail, because it speaks to risk management in a market this volatile. I'm splitting my exposure between physical holdings and strategic paper positions, but the allocation is heavily skewed toward physical. Roughly 75% of my silver exposure is in physical metal. Coins, bars, allocated storage, metal. I can verify exists. Metal I can take delivery of if necessary. Metal that has zero counterparty risk. The remaining 25% is in carefully selected paper vehicles, primarily options on silver miners, rather than futures contracts on silver itself. The reason for this is simple: leverage without liquidation risk. If I buy call options on a silver mining company and the price drops, my maximum loss is the premium I paid for the option. I can't get margin called. I can't get forced out of the position at the worst possible time. The position either works or it expires worthless, but I maintain control over the timing and the risk. Compare that to a leveraged futures position. If silver drops 10% and you're leveraged 3 to 1, you're down 30% and facing a margin call. You might be right about the long-term thesis, but if you don't have the capital to hold through the volatility, you get stopped out at the bottom and watch the rebound happen without you. I've been in this market long enough to know that being right about direction isn't enough. You also have to survive the journey. And in a market where the paper price can be manipulated through coordinated futures, selling, while the physical market is screaming shortage. Survival means managing your risk so you can't be forced out at the worst possible moment. So my allocation is deliberate. Physical for the long-term structural trade. Options for leveraged upside with defined risk. And cash on the sideline to take advantage of panic selling if the Fed does intervene aggressively. That's not sexy. That's not the kind of advice that gets clicks on social media. But it's the kind of positioning that keeps you in the game when the volatility spikes and the margin calls start hitting everyone who was over-leveraged. Because here's what 12 years in this market has taught me. The people who survive long enough to profit from being right are the ones who manage their risk like their financial life depends on it. Because it does. That's the number that tells you whether the Western pricing mechanism is functional or broken. I'm not guessing. I'm not throwing darts. I'm reacting to the triggers the market gives me. I'm watching the data, the premiums, the inventory levels, and I'm waiting for confirmation before I act. Because in a market this volatile, in a market where the paper price and the physical price are telling completely different stories, survival requires discipline. It requires a plan. It requires knowing your triggers before the chaos starts. And right now, as of early this morning when I pulled this data, we're sitting in the pivot zone. We're sitting at $82 with an $8 premium in the East, a drained vault system in the West, and a sovereign buyer in China that just dumped $500 billion in treasuries and reclassified silver as strategic. The setup is there. The math is there. Now it's just a matter of watching the triggers and reacting when the market confirms the thesis, the new reality. Let's recap what we've covered, because the pieces fit together into a picture that's impossible to ignore once you see it clearly. As of early this morning, February 9th, 2026, we had a record treasury dump by China. $500 billion rotated out of U.S. government debt. We had a reclassification of silver as a strategic asset on January 1st, effectively strangling 70% of global refined exports. And we had a massive physical-to-paper price disconnect, an $8 premium in Shanghai, that the mainstream financial press was either ignoring or fundamentally misunderstanding. The screen was showing $82. The vault was saying out of stock. The Shanghai street price was sitting at $130. And the paper market was acting like everything was fine. It's not fine. The era of easy money financed by the East is over. The era where China accumulated dollars, bought treasuries, and recycled capital back into the American financial system to keep yields low and consumption high is finished. They spent decades building dollar reserves. They spent decades financing American consumption. They spent decades being the buyer of last resort for U.S. government debt. And now they're done. They're rotating into gold, into silver, into strategic resources that can't be printed, can't be devalued, and can't be sanctioned. They're positioning for a world where hard assets matter more than paper promises, where physical supply matters more than monetary policy. And the Western financial system, built on infinite liquidity, built on fractional reserves, built on the assumption that China would always be there to buy the debt, is about to learn a very hard lesson about scarcity. Here's my final thought, and then I'll let you go. The screen may show $82. The vault says out of stock. You can believe the screen, or you can believe the vault. You can believe the paper market, or you can believe the physical premium. I know which one I'm betting on. If you want to see how the People's Bank of China set this trap months ago, how the pattern was visible for anyone paying attention, go watch the previous update on this channel. The breadcrumbs were there, the accumulation was there, the policy shift was telegraphed. The question is whether you were looking. There's one final piece of this puzzle that I want to leave you with, because it speaks to the broader implications of what we're watching unfold in real time. This isn't just about silver. This isn't just about one commodity market experiencing a supply squeeze. This is about the architecture of the global financial system undergoing a fundamental restructuring. For 70 years, the Bretton Woods system and its descendants operated on a simple premise. The United States provides military security and reserve currency status, and the rest of the world, particularly Asia, finances American consumption by accumulating dollars and buying treasuries. That was the deal. That was the implicit bargain that kept the whole system running. China just tore up that bargain. $500 billion in treasury sales isn't a trade. It's a statement. It's a declaration that they're no longer willing to finance the American empire in exchange for access to American markets. They've built their own markets. They've built their own supply chains. They've built their own technological base. And now they're building their own monetary system, one based on hard assets rather than paper promises. Silver is just one component of that transition, but it's a critical one because of its dual nature as both an industrial input and a monetary metal. It sits at the intersection of the green energy transition and the de-dollarization trend, and that makes it uniquely valuable in a world where both of those forces are accelerating simultaneously. When I pulled the data early this morning and saw that $8 premium in Shanghai, I wasn't just seeing an arbitrage opportunity. I was seeing evidence of a monetary and industrial system in transition, evidence that the Eastern and Western markets are decoupling, evidence that the paper pricing mechanism that worked for decades is losing its grip on physical reality. And that's why I'm treating this not as a trade, but as a long-term structural position. Because when a monetary system transitions, when the architecture changes, the people who position early for that change are the ones who benefit. The people who wait for confirmation from the mainstream, who wait for the financial press to validate what's happening, are the ones who pay the premium after the opportunity has already moved. You're here early. You're seeing the data before the narrative catches up. What you do with that information is up to you, but at least you can't say you weren't warned when the premiums blow out and the vaults go empty. This is first mover intel. This is the data before the mainstream catches up, before the narratives shift, before the talking heads figure out what questions to ask. The financial press will catch up in a few weeks, maybe a few months. By then, the premiums will be wider, the inventory will be thinner, and the entry points will be gone. You're watching this now because you understand that speed matters in this market. You understand that the gap between when the data changes and when the crowd figures it out is where the opportunity lives. I'll see you in the next update. Stay sharp.